Richard Yetsenga, Group Chief Economist, ANZ Research, is now joining in. Richard, great to have you. Thank you very much for joining in. Give us your read of the India-US framework deal, the interim deal, and what are the economic implications for India and how would it compare with the other emerging markets now?
Well, there's a lot in that question. You've given the headline numbers. I think the key thing, obviously, is that there is an agreement to back away from the most extreme tariffs, and that's not unusual from the US perspective. Typically, where things settle is well within inside the envelope of kind of the most aggressive position. I think the experience of elsewhere, though, is over time, different forces come to play, and it may or may not be that these are where tariffs eventually settle, depending on how things develop. So we can't rule out further surprises down the track, but what we can say is what we've had is very good news and leaves India much better positioned in the region. Probably its main issue from a trade perspective is kind of the tech-heavy North Asia story has been really leading the regional trade dynamic. But certainly from a pure tariff perspective, India back with the pack now.
Yeah, no, absolutely. Richard, so what will this mean in terms of risk appetite and how foreign investors view India? Because this was a sentiment dampener. Will all of that start to see a bit of a turn? Anything you're hearing specifically?
Well, it was a sentiment dampener, of course, and it showed up in the flows. For most of the past half year, India's tended to see net selling from foreign equity investors, and so that it's been a bit of an outlier in the regional, although investment in general has been patchy outside of that strong North Asian story. And I think probably that's where the main issue lies. What is your view about how this big AI thematic is likely to evolve? Because not just in the market space, but also in kind of what happens in real economies in the region. AI about the biggest swing variable this year. Will it repeat last year's super strong investment trade financing story, or will we start to see a bit more differentiation come out as we've started to see in some of the market price action?
Hi, Richard. Good to see you. There's a call that maybe, in fact, the US markets post the big outperformance could be getting a little bit expensive, and maybe it's extended itself. But, that's with regard to the equity markets. How are you reading the data points on the economic front in the US markets? Because the fear is that economy gradually starts seeing the impact of these higher input costs, and there could be a slowdown, which in turn could put pressure on the mother market, and then global equities itself could go in a bit of a tizzy. Your comment on that?
Look, I think it depends on where you look in the US. In terms of, GDP and the production side of the economy, things still look quite solid. Indicators are good. Momentum looks quite good. Business sentiment has improved a bit lately. If you look at the labour market and the pricing side, there's probably a bit less comfort. The labour market does look like it's in a weakening trend, and that hasn't really changed. And the pricing side still seems a little bit sticky. It's not at 3%, but it's certainly not at the Fed's 2% target either. So our expectation is you'll see the growth story continue, and that will be enough for the Fed to bring interest rates down, but only a little bit and only slowly.
Richard, you said that how India fares versus the rest of the emerging market hinges on what your view is on AI. So last week we had a bit of a scare, but on Friday, of course, tech names in the US rebounded. But what is the call ANZ Research is taking on AI? Is it a bubble, or does the rally continue in 2026?
Well, the bubble question is a bit like the reserve currency question. It's a very binary on or off. And rather than look at it that way, the question really is, with the sort of investment and trade directly related to AI that drove regional and global growth last year, do we expect that to repeat this year? And the answer is no. I do think markets will eventually become more discerning about what's going on, look for a stronger payoff. And so, Taiwan exports up 50% last year. This year is going to be a much more sober year, I think.
Just one last question, Richard. I'm not sure if Kevin Warsh has made more comments, because I'm seeing some headlines about Warsh this morning, about how he wants Treasury and the Fed to coordinate And of course, I mean, his long-standing view has been that the Fed should not intervene in markets. I mean, he wants lower rates, but not through Fed's balance sheet. Is there anything new you're picking up, and what's your sense?
Look, I can't see the comments, of course, because I'm talking to you. I would say, though, this is a new Federal Reserve. Under the new chair, it's going to be a different institution with some different focuses. He's obviously bringing some different ideas to the table. Some of them, to me, look quite unconventional and in some ways a little bit cross-purpose and contradictory. And I think over time the markets will respond to this Fed differently from the Fed that we've known, the institution that we've known over the past couple of decades. And so I think, I'm watching the long end carefully because, of course, we've had 18 months or 24 months where short-term rates have come down, but long-term rates haven't. And in fact, in a bunch of economies, 30-year bond yields have gone up. If the new FOMC chair is talking about even lower rates in the face of an economy that seems to be growing well above 2%, I think that's likely to contribute to further steepening in the yield curve.
Richard, we'll leave it there. Thank you very much for joining us. We'll keep chatting. Thank you. Let me tell